Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome back to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. There's a few things that mark that we're getting towards the end of the year. You know, people start winding down in Australia after the Melbourne Cup. The calendar ticks over to December, and all of a sudden, the calendar is filled with Christmas parties. But for us here at Equity Mates, there's one thing that marks the year is coming to an end, and it's when one of our favourite guests joins us in the studio to wrap the year and talk about his bold predictions. That is Andrew Brown of East 72 Dynasty Trust. Andrew, welcome to Equity Mates.
Thank you, Ren. Good morning, Bryce, and thrilled as always to be your Christmas party and be here.
Yes. So this is the last week of content for us here at Equity Mates in 2024. Starting next week, wherever you're listening or watching to this, we'll have our summer series. We've got 12 interviews with some great advisors and experts. But we bookend every year, Andrew, with bold predictions. You join us in our first week of content and have the very difficult job of making big predictions for the year ahead. And then you come at the end of the year and wrap it, and we see how you went.
Yes.
At the start of the year, you had 15 bold predictions.
I did.
So we're going to go through all 15 in this episode.
So the first prediction you made, Andrew, was that on November the 6th, the president-elect will neither be Joe Biden nor Donald Trump. Very close.
So I'm directionally,
right?
Yeah, well, I'm going to give myself half a point here. Okay, now that's not cheating. Okay, if you go back and look at what I was talking about, I said Biden would pull out for ill health. Well, I think that's a pretty fair comment on why he pulled out.
Definitely.
Okay?
Yeah.
So there's a tick there, and then I said Trump could pull out for ill health or a variety of other reasons. Now there was a hint that I was never ever going to say on a podcast. And I think the hint happened, well, certainly once and arguably twice, which is, of course, that he was shot at. So, you know, with absolutely no pleasure whatsoever, I think sort of that suggestion was right. Whilst the odds were always in Trump's favour, and we can argue about why that was it just money flow from some big whales betting? You know, it was pretty close leading up to the election, although it's been fairly clear that in terms of the overall vote, it's sort of 50 to 48.5, if you will. So that's pretty close between Trump and Harris, you know, without analysing the election, because there's no need. It's pretty obvious, I think, why Trump won. I think that it got a lot closer to Harris winning than, would have ever been thought possible when we recorded on the 18th of February. So I'm going to give myself half a point for that, in that there was a third party came along and, not called Trump. Nor Biden.
So let's get out of the world of politics and get into the world of investing. And the conversation at the start of the year on the tip of everyone's tongue was inflation and interest rates.
Yep.
And so your second bold prediction was that US inflation would fall into the twos, 2 point something percent. But you believed that bond yields would not fall below 3%, and you said because the US is running a budget deficit of 6.3% of GDP.
Of every prediction I made on the 18th of February, I think, let's just say we nailed this one completely.
Yeah.
I was very adamant, and if you re-listen to the pod, you'll very much find that, I said US inflation is not an issue. It's just not an issue, and everybody was panicking about it. And it was very clear to me because of the base effect of what was going on, what had gone on in 2023 and what was going to fall out of the numbers, that US inflation was virtually inevitably going to come back into the twos.
And just for people who are unfamiliar with the base effect, it's that because the prices had grown so much between 22 and 23, then the year-on-year numbers then were going to come down because the baseline was higher.
And that's basically what happened. The bigger call was that US bonds wouldn't go below 3%. I'm to be blunt with you, they never even went close to going below 3%. The low for the period since we recorded was 3.62. And in April, they were actually 4.7, despite the fact the inflation trend, I think, was very, very obvious for the whole year. And they finished round about 4.2, up from sort of 3.87 at the year end. Just keep those numbers in your head for later on.
Deal. Number 3, the Magnificent Seven will fragment completely.
Well, I'm going to give myself a half on this, okay? That is being really generous.
Yeah,
Very generous.
It's being extraordinarily generous, actually. If you go back and listen to where
how are you going to say that they fragmented?
Well, since we recorded, Microsoft's up 5% and Nvidia's up 87%, and Tesla's up 73%. We'll come back to that in a second. And the others are all in the low 20s, apart from Apple, which is up about 30%.
So you're saying that Microsoft has fallen out of the Magnificent Seven?
No.
Yeah, I don't think you're saying that.
I'm not saying it's falling out of that. That's a fragmented performance. Now, if you want to really criticise me, and fair dues if you do, I did say I sort of thought that Tesla was pretty much slipping out of there already. Well, quite clearly, the whole presidential election things changed that, and clearly that a lot of the stocks, I mean 3 or 4 of the stocks all did 20s, and I expected Apple, there's no way I thought Apple would return 30% in capital growth terms since the 18th of February, because we're talking about, it's slowing earnings, etc., etc. Likewise, Tesla, the performance of the business is such that it's very difficult to understand why the stock has returned 70+% since February. The other stocks returning in the 20s, there are varying reasons why they've done that, some of which are actually eminently justifiable. So I'm going to give myself half a point simply because 5 to 87 is a fair range, whereas the prior year it wasn't such a big range. You can fairly reasonably kick me around a bit because, of course, the things I thought would fragment out actually nearly fragmented out the top.
Yeah,
not the bottom.
I think there's probably a definitional challenge around what fragment means, but look, let's keep moving because we do have a lot to get through.
We do.
And I think this next one there's no half points on the line here. No. Number 4 was Elon Musk will leave Tesla. And I pulled a quote from the episode. You said, I'll be blunt, I think the man needs help.
Yes.
Now, you may have been right.
Half a point.
You may have been right about that. But Elon Musk is firmly ensconced in Tesla.
Well, is he?
Yes.
What, you reckon he's out?
I'm not going to give myself halves or quarters or anything, okay? This is a 0. He hasn't left Tesla, okay? But I did say I think he'll focus on some other things. I never thought in my wildest dreams he's effectively moved into the guest room at the White House in January, and he's certainly moved into a guest room at Mar-a-Lago. I'm staggered and stunned. I can't see that relationship ending well, No. So there is an issue as to, his focus. This man must have, sort of 60 hours in each day to actually do properly, what he's now going to be trying to do. And I think it shows. I mean, the business performance of Tesla is not great, to be quite blunt. It's not innovative. It's not innovating. It's got very little new models, and obviously the sales are slipping against a much more competitive environment.
Now, we don't have time to debate the point, but I think it is worth just flagging that there is obviously another side to that conversation around cyber cabs and humanoid robots, which,
absolutely.
But that is a conversation that will continue in 2025.
Yeah, there's another side to the conversation, which is that the bloke he's working for doesn't like electric vehicles.
Yes.
I know, right?
He likes money, though.
All right. So, Andrew, number 5, you said it smells like 2000. In fact, I think you said it stinks like 2000.
Oh, yeah, I did.
You said equities will be an okay place to invest, but not the index. The index can go down.
Yep.
And if you're smart about it, you can still make a good return in 2024. I think if you were smart about it, you probably stayed in the index in 2024.
Oh, yeah, absolutely. To give you an idea, since we recorded the episode, the S&P 500 is up about 20%. The NASDAQ is up about 17%.
Yeah.
The Russell 2000 with a late bolt, mainly in November, hasn't quite matched those, but it's got a lot closer to those returns. And in Australia, the market's up about 10.5%. There's no question that, despite the late bolt in the Russell 2000, small caps have underperformed, but by and large. So being in the index, and particularly being in the S&P 500, as it's turned out, that's been the easy trade. I think that's a problem, and I think what we prefaced at the start of this episode about we may not have been, or I may not have been wrong, but I may have been early, perhaps carries there on this particular prediction more than any other. The reason I say that is that interest rates in terms of the 10-year bond in America are higher now than they were at the start of the year or when we recorded in February. They're about 4.2 against 3.87-ish. Okay, so when bonds go up like that, and particularly when it's happening with a risk premium being attached to credit risk, and pretty obviously the US deficit is doing that, and we did mention that 9-10 months ago, but also earnings expectations for the S&P 500 are lower for 2024, where obviously we're down to the last month or two, but they're no higher. In fact, they're slightly lower. I do mean only slightly lower for 2025. So you've had earnings expectations going nowhere to down and bond yields going up. That's not usually a recipe for major returns in equities and not returns of a 20% plus nature. So that is quite bizarre. And at some stage, particularly given what's happened in November, I think that must start to unwind. What's driven things is simple. It's animal spirits.
Well, no. What's driven the things is simple. It's that the biggest tech companies have continued to get incredibly more profitable. We did something on our Instagram recently that I've just pulled up. Last 2 years, so Q3 22 to Q3 24, Nvidia obviously up more than 2,500% profit, but Meta 250% profit growth in 2 years, Amazon 450%, Alphabet 90%, Microsoft 40%.
And
Apple's gone backwards, but
and you know why? Because you beautifully picked the absolute low point for these companies, not in terms of stock, well, actually in terms of stock price, but also in terms of the way they were running their business.
Yeah, they got more profitable.
Well, they got more profit. Why have they got more profitable? Because they sacked a whole bunch of people. You picked the time that they were, it was kind of like, it was like saying, I'm feeling much slimmer. I weighed myself on the 15th of January after I'd spent a month stuffing myself and drinking. These companies, Meta's the best example of the lot. They had extreme tech blight in terms of employees. They were spending obviously vast amounts of money on all of the sort of AV stuff. And what they've done is they've refined their strategy. They're infinitely more profitable for sure. But don't forget, are they, their stock price, for Meta in particular, sure, their stock price is higher than it was in 2021, but it's not vastly higher. The ones that have obviously, where the world has changed for them is obviously Nvidia. So they're more profitable, but don't forget the share prices were never reflecting, with the exception of Meta, really sort of negative environments.
Nice. Well, let's go to number 6, Andrew, which is there will be a major scandal in AI.
It hasn't happened.
No.
It hasn't happened.
Number 7 then was that you believed media ownership in Australia was going to have a shake-up. The reason is that Channel 10 belongs to no one, notionally belongs to Paramount. Foxtel was declining at a rate of knots. Radio market was in flux.
Yep.
And so you thought that this was a moment that there was going to be a bit of a shake-up.
Okay, if you've been counting carefully so far, I'm 2 from 6. Okay, so number 7 with media ownership. I'm going to give myself a half.
Yeah.
Okay, now again, you might think I'm being generous. Paramount, who are the owners of Channel 10, they have changed hands. So a company called Skydance has bought them after a very, very lengthy sale process. I think that there's been a change of management at Channel 9, and obviously people are starting to wonder what's going on there. The new guy's relatively inexperienced. And there's quite clearly a lot of fissures at Channel 9, and people are starting to explore hang on, why do we own half of Domain? Why do we own radio? Can you break it up? Can you do a sum of the parts? And pretty obviously Channel 7 during the course of the year had a major upheaval in terms of management. Pretty much all the management got shipped out. It's now clear pretty publicly, I think. Previously they were trying to hide it under the covers, but it's pretty clear that 7 Group Holdings don't really want to own their 34% of Channel 7 or 7 West Media, and it's very clear that that's in the hands of Dad, as we know it has been for the last 2 years. So I'm going to call this one a bit early because I think it's virtually inevitable that something will happen in 2025, because these companies just are not. They're making money, but the trends are just so horrible. And people are exiting at a rate of knots. They're exiting the industry. You're seeing it right across the industry. I mean, ironically enough, probably more so at the ABC than anywhere else at the moment, particularly in radio. But personalities are exiting, and you can see the cost cuts just more and more and more and more. I'll give myself a half because of Skydance and Paramount, but you can bet your bottom dollar I might carry that one over.
I think we enjoy doing this not because of the score, but because of the thinking that goes behind it.
Absolutely.
And so I think we're not getting too hung up on right, wrong, half points, full points.
Nah.
But I think it's just interesting to think about where the world might go and some of the forces that are shaping it. And I think
I
the
agree.
decline of traditional media is may not have happened this year, but it is certainly happening before our eyes.
I agree, Alec. And if people actually wonder why I do this, it's for that exact reason. I have to sit down and sort of think about a whole range of things, not from an economic standpoint necessarily, but, in the last couple of years, I've tried to introduce more industry type thinking into it, because I think that's better for everybody to think about in terms of how they might position their portfolios, whether it's through stocks or ETFs. Where do I want to be? To me, it's, when we come back and have a look, it's not that, I nailed that. It's much more, what's the thinking behind it? Was the thinking behind it completely and utterly wrong? Bear in mind, I can't change the thinking mid-year. I get a chance to put it out there and a chance to review it. And this is a really good example of that. And if you've been a media investor over the course of 2024, certainly in Australia, bluntly, there's been one stock to own, which is News Corp, which is not really Australian anyway. And if you've been in Australian traditional media, I'm sorry, you're in pain.
Well, Andrew, another force shaping our world, and one that you're certainly very interested in, is the rise of the business of professional sports. You joined us halfway through the year to speak about Catapult, a fascinating Aussie company, so people can go and listen to that. But your 8th bold prediction was around the business of professional sport, and you predicted another English Premier League team would be publicly listed by the end of the year.
Hasn't happened, so I've got to give myself a 0 on that. However, what's continued to happen is the morphing of sport into the investment market is just continuing apace. A lot of it clearly is private equity. Private equity's involvement's unbelievable. I think private equity are getting it wrong because I think they're investing in teams, and that's often not the right way to be. There are some people getting it very right, who are buying cheaper teams, shall we say, who are outperforming because they're using technology and metrics to employ the right managers, and those managers are using tech and metrics and the right people to get the right players. I'm very focused on the English Premier League because it's the one sport where the assets are available for sale. The players can be sold, so if you find a young player and you pay 5 million quid for him, you can resell him for 100 million quid, and make a phenomenal profit. But I think this is going to continue simply because of some of the factors that are at work in media. The fact is that big media, and by big media, we're talking Amazon, we're talking, potentially components of the Magnificent Seven. They've got the money to spend on eyeballs, and eyeballs are attracted by live sport, which varies from region to region. There are two globally ubiquitous sports, and I mean global. So I'm going to discount cricket, but the two globally ubiquitous sports are basketball and soccer, and that's working in both those markets. With mega media deals. So that's big money. People want to watch it. Don't matter what time of day, don't matter what part of the world. It's the fact they're both global. And that's the key to me. So there's going to be more intrusion of both public and private equity markets into professional sport in 2025, no question.
Number 9, Andrew, is around the Aussie dollar.
Yeah.
You thought at one stage that it'd get to at least 75 US.
Yeah.
For context, as we're recording, it's about 65.
Yes.
I think it did almost, it reached 0.69 or 69 cents.
That's right.
Never breaking through 70.
In a world of complete chaos and volatility and lunacy in 2024 so far, guess what the most stable thing in the world was? The Australian dollar, US dollar exchange rate. The low was very briefly 64. The high, very briefly, as Bryce pointed out, was 69. It's traded in really a range of 65 to 68 and a bit the whole year, which is remarkable when you think about what you read about the Australian economy and the way the Australian economy is going. Okay. And of course, the events in the US, the way the US budget deficit's panning out, the way US financial markets are panning out, and obviously the way US politics have panned out. You would have thought this would be really volatile. Did not happen. No. So I was really surprised. So we'll come back and see what we think about that, potentially in the new year. Because it's not clear, I've got to tell you. There's no clarity about where the Aussie might go.
No. Well, there's no clarity about where the US dollar might go,
Correct.
and that's going to push everything around.
That's right.
But, Andrew, bold prediction 10 and bold prediction 11 were thematically tied around inflation. So let's attack them as a pair, because upon reflection, I don't think bold prediction 10 was very bold at all. You predicted that the official Reserve Bank rate would not get below 3.25% this year. And it was at 4.35 at the start of the year, still at 4.35. So obviously you were very correct there. And to be fair, there were predictions of multiple rate cuts in 2024.
Yeah, absolutely.
But we didn't see any.
No.
Prediction number 11 was also around inflation. So you predicted that the Aussie CPI stays at least 50 basis points higher than inflation in the US.
Yeah.
At the time of recording, the US was 3.4% and we in Australia were at 4.1%. Yeah. So how did that play out?
That's played out very well. Now I'm going to exclude the government's electricity subsidies. That's so if we take those out, then we're basically in a situation where Aussie inflation's about 3.5.
Yeah.
Okay, excluding those.
Now, for people, the Australian CPI is 2.1%, but Andrew's point is there's a lot of government policies pushing that down, which aren't long term. The trimmed mean inflation is 3.5%.
That's correct.
And it actually rose from 3.2% in the last measure.
Yeah. And, US obviously we're down in the twos.
Yeah, so I think we looked at I think the US 2.6.
2.7. So, basically that prediction's proven correct.
Yeah.
Prediction number 10, which was that, the RBA rate wouldn't get below 3. Now, you've got to give me one easy one out of 15. However, I think, as you rightly pointed out, Ali, a lot of people were saying there's going to be an absolute truckload of rate cuts, and I never believed that because I thought it would have been crazy economic policy.
Well, here's the question, Andrew. A lot of people are saying in 2025 there'll be a truckload of rate cuts. Crazy? Not so crazy.
I think it's still crazy because we still have an inflation problem.
Yeah.
Inflation is so... I mean, the reason I gave that, and I used the word sticky at the time, was that inflation was too sticky in Australia, and I did not see it as being sticky in the US. To me, I think I will not make the prediction again that our CPI will be at least 50 above the US, because I think the things happening in the US that will make their inflation rate start to potentially move back up.
Tariffs, tax cuts,
etc.
deportations.
Yeah, I'll claim both of those.
Nice.
And, it wasn't quite as a sort of easier call as you think. But I think the one thing we can say, and I strongly give this advice to the listeners and watchers, okay, which of course was Peter Lynch, which is basically, forget about economic forecasts. Just focus on your companies or your industries. Just, don't worry about this. I mean, if you can find an Australian economist that's been even half right in the last 12 months, I mean, please name them because I can't. Also, I come from England and I learned my economics in the UK. And, I have to say, I think the standard of Australian economic commentary is appalling. I think it's really, really appalling. And the reason why is because they're all frightened of losing their access to the Reserve Bank. So they will just parrot it. And now they found it a bit more difficult because I think Michelle Bullock is excellent. Whereas, unfortunately, I didn't quite have the same opinion as my predecessor. But I think she's absolutely outstanding. She's calling it absolutely right. And I know she's obviously under vast political pressure because of housing, and we know the impact, interest rate impacts on housing in Australia are vastly different to everywhere else.
Well, Andrew, we've got 4 to go. We're going to take a quick break, and on the other side, we'll close out with some of your picks around some individual stocks and some of the investment opportunities that you had your eye on. So we'll be right back. Welcome back to Equity Mates. We're here with Andrew Brown, closing out the bold predictions for 2024. 4 to go, Andrew. So number 12 was around small caps and small caps outperforming big caps.
Didn't happen.
No.
It's not as far away as it... if we'd have recorded this in about September, October, I would have been looking eminently foolish. Small caps have rallied quite strongly over the last sort of couple of months.
So for context, we had a look year to date. The XSO, which is the Aussie small caps, is up 9% year to date.
Yep.
XJO, which is the ASX 200, is up 11% year to date.
That's correct.
So
it's closer, but what's clear is that to get small caps rocking and rolling, you really need a slightly better economy than we've had. Because obviously in Australia, the small caps really are made up of, to try and generalise, which is a bit ridiculous. But obviously there's a resource component, and gold stocks have not responded to the gold price, which come on to in a minute, in a way that you would have thought. They have to a degree, and we're actually talking on a day where there's been a reasonable takeover offer or agreed merger between two, Northern Star and De Grey Mining. Sort of some of those stocks, some have done quite well. I've had a couple of gold stocks that are sort of treble plus, but they were just trading at, ridiculous valuations. But, by and large, the money's just gone into the big caps, mirroring really what's gone on in the US, but for no good reason. Because, bluntly, the outlook for banking in this country is absolutely dull. They've all got extremely low bad debt charges, which can realistically only go one way. They can't really get much lower. Their interest rate margins obviously are nailed to the floor, and they're not going to move dramatically, in my opinion. There's some level of credit growth, but it's not great. And yet people are pricing them at, premium, in one case, obviously premium multiples just about any other bank in the world in CommBank. The others, the environment's not that great for them. Obviously, the miners, the environment's not that great for them at this moment in time. I mean, that can change, as we know. So, I've been a bit surprised. It's really been a money flow argument. And that's really what's driven the big caps rather than anything, particularly attractive about the securities at all.
Andrew, let's move to number 13 because you touched on it there. It was about gold, and you made the prediction that gold stocks would do really well from here.
Yeah.
And you were definitely directionally right because gold had a ripper year.
Oh, yeah.
And I guess it just depends which gold stocks you had in your mind.
Absolutely. I was very clear about the fact because I'm an extreme cynic on gold company management.
Yes.
Okay.
Yeah.
And so what I usually do is say if you have a positive view on gold and you have a positive view about the valuation of gold stocks as a group, then buy an ETF.
A gold ETF?
A gold ETF.
Yeah.
And I always mentioned GDX, which is the VanEck Vectors Gold Trust. And that's up 41% from the broadcast.
Nice.
Its junior equivalent, which is, obviously slightly more speculative, is up 46%. The gold price is up about 33% from when we broadcast in February. So that's an okay call. And I did mention the ultimate contrarian gold stock. And of course, in October, November, it showed why it's the ultimate contrarian gold stock, which is the world's largest gold miner, which is Newmont. So Newmont with $33.43 on the date of broadcast. They reached a high of $58.72, which was in October. And then they published their quarterly results and the stock went from 58 to 42 in a week. Because, guess what? Newmont management have done their usual trick. So it's not a management quality miner. It's got brilliant assets, as you know, including the new Crest assets that were listed in Australia. But I said that's one obvious way to play. You would have earned at least a market return with the potential of a substantially above market return. So I'm collecting a point on that one.
Okay.
Nice.
Okay.
Nice.
Number 4 was short and sharp. You said I'll be buying oil stocks today. Now, if we looked at Exxon, it underperformed the S&P 500.
Big time.
But where were you actually thinking in that space?
I was thinking Exxon, so that was up from 103 to 118, but that's nowhere near the returns of the S&P.
Yeah.
If you'd looked at Chevron, then it's 154 to 163. That's nowhere near the return. If you bought Brent futures, you'd have been buying them at 80 and then now 72, so you would have been making a negative return. They did touch 92, but that was back in April. Okay, and if you followed Warren Buffett and were buying Occidental at 60 odd, then they're obviously down in the low 50s. I do own Occidental, I should add. Okay, so I'll be buying all stocks. Well, I'm hodling them at the moment.
Nice.
Yeah.
I'm sorry to say, of course, on the theme of consolidation, number one, I do caution everybody. I've not seen animal spirits like you saw in November in the market for quite some time.
Yeah.
It's been led by fringe things like crypto, but that's spilled over into real companies in the markets going up 20 and 30%. To give you an idea, I have a portfolio of 37 stocks and 2 of those are up 40% in a month.
Wow.
Okay.
It's not bad.
And I had several others up 20. That's crazy. I just don't expect that. And a lot of that went on in really, really big companies. So I'd advise people just to be careful. Times like this don't last, and they usually don't last very long. And when they stop, they don't just stop and things are calm. They stop and things fall in a heap. So I think we're going to see some consolidations next year, but obviously we'll examine that much more in January. And for me, the bold predictions 5 for 2024 was most definitely a year of consolidation because we amassed the grand total of 5.5 out of 15.
Okay.
Nice.
Which I think goes to show Peter Lynch was absolutely right.
Yes.
Nice. Love
Well,
that.
as Ren said at the top, it's no easy task. We get you in here each year, but we thank you nonetheless.
Oh,
It's
pleasure
always
to
a lot
try.
of fun. We will
Pleasure
have
to
you
try.
back again early January.
Yeah, no,
To
looking
do
forward
it
to
all
it.
again.
No,
Put your neck on the line.
Yeah. No, I think it'll be, I do think 25 is going to be extraordinary with a change of president and a very fundamental change of president, and obviously some of the key people he's putting in key positions. Who knows what's going to happen? I mean, I remind people the last time Trump was president, you were sort of waking up in the morning, in Australia, and there'd been some edict that he'd put through presidential decree, sort of, usually on tariffs and things like that it just changed the face of an industry, with one stroke of a pen, if it was enacted. And then you have to go through the rigmarole of, is this going to get up? Can it get up? What's going to happen? How's the response? It was a really volatile period. It was a very difficult period for investors. So, we back with that. Like it or not, doesn't matter. That's what we're back with.
Well, we'll leave that as the cliffhanger for, we'll all be back next year with our own bold predictions. So, Andrew, have a great Christmas break. Absolute pleasure as always. We appreciate it.
Excellent. And thanks for having me on 2 or 3 times this year, and thoroughly enjoyed it.
Thanks, Andrew.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.